We'd like to thank this week's podcast sponsor, Coinbase, a leading online cryptocurrency platform for buying, selling, trading, storing, and staking cryptocurrency. Coinbase is the only major publicly traded crypto exchange in the US, and it's used by millions of users in the UK alone. With a wide selection of more than 250 cryptocurrencies, industry-leading security measures, and a seamless user experience, Coinbase makes it easier to explore the world of crypto, whether you're just getting started or looking to expand your portfolio. To start your crypto journey, sign up through the link in the podcast description. But remember, don't invest unless you're prepared to lose all the money you invest. It is a high-risk investment, and you shouldn't expect to be protected if something goes wrong. Hello and welcome to episode 506 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing? Well, I can see from your face how you're doing because you've got an update on what happened last week.
Yeah, I know this is going to be just over more than a week ago since the events of Bilbao, but please indulge me because, as you know, if you listen to the podcast in recent weeks, I travelled to Bilbao to watch Spurs play in the Europa League Cup final, and as a long-suffering Spurs fan, season ticket holder, I'm obviously pleased to say that we won the final in Bilbao against Man United, and it was amazing. For those of you who followed us on our socials, on Instagram, we had a story showing our travels to the game, and it started out, we went from Gatwick to Madrid on the Tuesday. We stayed overnight for a few hours, then got up in the morning and drove all the way to Bilbao, which was about 3.5-ish hours, to a place just outside of Bilbao. We stayed in a lodge, really, that was way up in the hills. If you imagine the cross between the Sound of Music and Cumbria, because the northern part of Spain, if you've not been there, is incredibly green because they have weather very much like ours. And so we've gone from the heat of Madrid to the kind of British-style weather of rain and cloud and gloom. And then we went from the lodge to the city, and we went and spent the day in the city and then went to the game. And, of course, the result was incredible. The atmosphere was amazing. We met loads and loads of fans out there in the fan park. It was incredibly well organised. That's the one thing I would say from the club, but also from the city mainly, in terms of where you had to go. Despite what you saw on TV or people mentioned when I got back, there wasn't really any trouble out there at all. It was very good-natured. I think if you've got two sides who are universally accepted and accepting of where they are, and that is basically at the bottom of the Premier League, then I think they had very low expectations as to what was going to happen. And there is no real, I suppose, animosity between the two sides. There's no real rivalry, given that Man United win things and we never do. So it was a really good atmosphere. And like I said, we met lots of different people who had some crazy journeys to get there. Way crazier than I had. People who've driven for like non-stop for like a day, people going via the most bizarre routes, having extra holidays to try and get the flights to get them to Bilbao in time, spending like a week in Magaluf and all sorts of things. So yeah, the game was great. Afterwards, the sort of street party was brilliant, and then we headed back to our lodge in the hills in the early hours of the morning, and then we came back about a day or so later via Madrid again. So a lot of travelling in the space of about 3 or 4 days. It felt like I didn't stop. And interestingly, as an aside, I said I met a lot of people. I actually met one of these Sky Sports news presenters out there when Justin and I were staying in a hotel on the last day before our flight at we had to get up about 3 a.m. to come back to the UK. We were in our hotel and we're having dinner, and we ended up bumping into a group of people who turned out worked for Sky. And in the end, I did recognise one of the people who actually is a presenter who does all of the transfer updates on Sky Sports News. And we spent the evening with them. They were chatting away, and it was really good fun. And when you're in an atmosphere like that, what's great is when you bump into people, everybody's felt like in Spain who wasn't Spanish was there for the football and open to chatting, and it was just a really good vibe between, like I say, both sets of supporters. So yes, Andy, I'm absolutely buzzing. I will stop going on about it, but you have to give me, if you listen to this, some leeway, because it's been about 40 years since we've won a major trophy like a European Cup. So yeah, we are champions of Europe at the moment. So it was brilliant. I loved every minute of it.
I have to say, I mean, I love working for Money to the Masses anyway, but the last week in particular has been particularly sweet to be around you and Justin. You've been skipping along and just enjoying life. It's been good fun. And there's been lots of other things happening in the background at Money to the Masses. One sort of work related, one not work related, but we'll save that for updates on next week's podcast. So I suppose that brings us to what's coming up on this week's show. Damien, you're going to do the first bit.
Yeah, so I'm going to be doing a piece on ethical investing and sustainable investing. It was inspired by a question from a listener who mentioned that they're trying to get their son into investing, and they mentioned about investing in a global tracker, but their son didn't want to because they didn't want to have exposure to defence stocks, so companies that make ammunitions, for example. And so they asked me, well, how do they go about investing without having exposure to certain themes? And so this is all about ethical investing and sustainable investing. And the reason why this is a particularly key topic to bring to the podcast, because since we covered it probably a few years ago, there's been some massive changes in the UK in terms of the FCA directives and this legislation around the labelling of certain investments. So I'm going to give you an update on that. And Andy, you're going to be covering two pieces on the podcast this week, which is quite good because it saves my voice. Because the one downside of travelling and having an impaired immune system like mine is that I've been sick for most of this week with the post-airplane cold. So it'll save my voice. But you're doing two pieces this week on the podcast.
Yes, so the first piece, the energy regulator Ofgem has been busy really in the last week or so, first announcing a change to the energy price cap, but it also announced a compensation package following the completion of a review that affects 8 major energy suppliers and around 40,000 customers. So I'll explain exactly who is impacted by that, how much they can claim, as well as an update on the best fixed price energy deals, and we'll be doing that later on in the show. And the final piece I'm going to be covering is just a quick piece really. Many listeners will of course have witnessed a gradual decline in the interest rates being offered on their savings accounts and cash ISAs. Of course, there's been cuts to the Bank of England base rate. And with further cuts expected, it means savers have to be proactive when it comes to securing the best rate on their savings. So I'm going to be looking at a particular way, almost a cash ISA hack, in which listeners can easily move from one cash ISA to another. I'll explain more later in the show.
And just to reiterate that point, it has been frustrating because in the lead up to the end of the tax year, we saw a price war, didn't we, with cash ISAs, with, well, almost every hour, different providers were trying to be the leading rate in the market to capture customers. Of course, once the tax year passed and we entered the new tax year, we've seen those rates come down. There is still a bit of a price war going on, not as keen as it was at the end of the tax year. But what is frustrating, and lots of people out there who listen to the podcast will be sharing in this, is they will have seen the rates come down on some of their savings. And if you're in a cash ISA in particular, they want to keep that money within an ISA wrapper, but you might want to move it around. It might seem cumbersome, but Andy, like you said, has got a bit of a hack for you.
Okay, so let's move on to that first piece of the podcast then, Damien. You're going to be talking about ethical investing.
So I'm going to explain how you can go about investing ethically or sustainably in line with your views, plus some of the best free tools to help you find funds or companies that you might want to invest in. In the last year, there's been a massive shift in ethical and sustainable investing in the UK, specifically when it comes to unit trusts, investment trusts, and exchange traded funds. So they're known as ETFs. Now, a lot of investors want their money to do good, not just to make them profit. So that's why they'll start to think about where they place their money if it's doing good. And that's where we get to ethical investing or sustainable investing. But recently, there's been a massive change in how ethical investments are categorized and promoted. So if you've previously looked for ethical options, you might have noticed things do seem a little bit different when you look at them now. And that's due to the Financial Conduct Authority, the FCA. They actually had a new sustainability disclosure requirement known as SDR. Now, this framework was designed to bring a much needed transparency and combat what was called greenwashing, where funds were making misleading sustainability claims. But if we rewind a little bit to pre-SDR, then historically ethical investing was awash with jargon such as socially responsible investing, SRI, words like impact investing, ESG, green investing, dark green investing, light green investing. And now the problem was that there was a lack of standardization across all of those terms. And so funds could use labels like ethical, sustainable, or ESG without a clear or universally agreed upon definition. This ambiguity made it incredibly difficult for investors to compare funds or verify if their claims were genuine, which is where the phrase greenwashing came in. So this flaw is precisely why the FCA decided to step in. So the FCA's Sustainability Disclosure Requirements, or SDR, came into effect on the 31st of May 2024. And the idea was to try and build trust and provide clarity. And it was deemed a bit of a game changer for how sustainable funds were marketed and evaluated in the UK. Now, it hasn't quite gone as they thought it would do, but there are two main pillars to the SDR. The first is an anti-greenwashing rule, which is mandatory for all FCA authorised firms. And this rule demands that any sustainability claims made in communications must be fair, clear and not misleading and proportionate to the actual sustainability profile of the product in question. And this is a crucial baseline protection against misleading marketing, even for funds that don't adopt the new labels, which I'm going to come on to. Now, the second pillar is the voluntary labels I've just mentioned. And these are labels which fund managers can choose to adopt for their products from the 31st of July last year. Now, the system introduces 4 distinct investment labels designed to help you differentiate funds based on their sustainability objectives and approaches. Now, to qualify for any of the labels, the fund must meet strict criteria, including investing at least 70% of its assets in line with its sustainability objectives. Now, the 4 labels that I'm showing on screen include sustainability focus, and this is for products that invest in assets already deemed environmentally and socially sustainable, consistently meeting a robust standard. This has been the most popular label so far that funds have applied for. Then there's sustainability improvers. This is for products investing in assets that have the potential to improve their environmental or social sustainability over time. Then you've got sustainability impact. Now, this label is for products whose primary objective is to directly achieve a positive, measurable environmental or social outcome. And this is the second most popular label. And the last label is sustainability mixed goals. And this is for products that combine elements of the other labels, pursuing sustainability outcomes both directly and indirectly. Now, before I move on, there is also a new naming and marketing rule which came into effect from December 2024, and there was a bit of temporary flexibility until the 2nd of April 2025. And what it means is that funds that don't qualify for a label or choose not to have one, don't forget you don't actually have to apply for a label if you don't want to if you're a fund house, but if you still have sustainable characteristics, they must clearly differentiate themselves. So this means that many of them will have changed their fund names, and you will have seen that in your own portfolios where funds have suddenly changed names in the last couple of months. So while the SDR labels are good news, it's something we've needed in the sustainable investing world, fewer funds have adopted the labels than initially expected, but the latest estimates are that there are around 100 funds that have adopted the labels. But while that is positive news, it has created a bit of a 2-tier market which you need to navigate. So many long-standing ethical funds, especially those focused on negative screening, like avoiding arms dealers, haven't applied for SDR labels because the labels are focused on sustainability, which is focused on investing in organisations that can demonstrate great practices and policies in terms of environmental impact or their social responsibility, and also the quality of their internal governance. Ethical investing is something slightly different. It is subtle, but ethical investing tends to focus on excluding certain investments rather than an outright explicit sustainability objective. So that means ethical funds can be sustainable in nature, but that is not what their objective is, and therefore they will struggle to meet the label criteria to apply for a label. So there are many, and in fact most, ethical funds. In fact, there was only one ethical fund that the last time I checked that had an SDR label. Most don't have an SDR label because of the way they are managed. Now, these funds have been around for decades, so it doesn't mean they're not a good choice. It's the difference between ethical investing and sustainable investing. One is a subset of the other. So what does that mean for you if you want to make ethical investment choices? Well, firstly, you need to define what your ethical stance is. That's not changed. So there's no single definition of what ethical means. And so you are having to make that choice yourself. And primarily, you're going to have to focus on looking at investments, fund fact sheets and their prospectuses to see if they meet your own criteria. That means there's probably going to be negative screening involved from your side, and you're going to have to find funds that maybe exclude certain sectors or companies, like I've already mentioned, arms dealers. So if you look at a fund fact sheet, you'll want to consider the underlying investments that the fund invests in. Now, that will require a bit of work, but fortunately, there is a way to find out the ESG rating of an individual company, which is useful if you want to invest in the individual stock directly, if you want to invest in shares, for example, or if you're just looking at the holdings within a fund that you might want to invest in. Then S&P Global have a really useful tool that gives ratings on a whole range of ethical criteria. There's a link to the tool in the notes, but as you can see on screen, you just simply enter the company in question, and then you can scroll down and see how the company compares against its peers within the same sector on a whole range of different ethical or ESG criteria. So that can be things like customer relations, supply chain management, sustainable raw materials, business ethics, climate strategy, occupational health and safety. So this is free to use and allows you to get very granular when it comes to making judgments on ethical and sustainable investment options. But let's assume instead that you want to focus just on sustainable investing and you want to use the official fund sustainability ratings, the SDR ratings, as a starting point for your research. Now, the difficulty is that the FCA doesn't actually publish a list of the funds which have secured each rating, which isn't very helpful. However, I found a way in which you can research these funds. So if you go to Fidelity, the investment platform has an investment finder. There's a link in the notes, and you can use their investment finder to screen not only unit trusts, but also ETFs and investment trusts by a whole range of criteria, including the sustainability label. So you can pick one like sustainability focus, then you can find the various different options under different asset classes and then start your research from there. Crucially, you don't have to be a customer. This is a free to use tool that everybody has access to. Now, using that tool, you can also add the fund to a watch list, look at past performance as well. But what about if you actually want some suggestions rather than carrying out your own research? Perhaps one of the best ways to find sustainable and ethical unit trusts, investment trusts, or ETF ideas is use the research provided by another investment platform, namely Interactive Investor, which is also known as II. Now, Interactive Investor has an ACE list, so it's called the ACE 40, which is the UK's first rated list of sustainable investments and contains 40 funds on there. Now, you can see there's a link to the list in the notes again, but you can see on screen they are categorized by their different asset classes that they are exposed to, and you can click through to find out more information about them and carry on your own research. But what about if you want to find passive funds, such as trackers that invest sustainably or match your ethics? Now, this is a tricky one, but one of the best ways to find funds is to use the Morningstar's Fund Screener tool. Again, there's a link in the notes. I'm showing it on screen, and you can look for funds based on Morningstar's own ESG rating, as well as other criteria such as management style, so you can pick active or passive, or even performance risk. So if you look at the tool, you click on show more, you can see the ESG risk ratings. These are proprietary to Morningstar. You can read about how they assess individual funds, but you can then pick the management style. You could go for passive, for example, and then when you click on the funds, it will show you those funds with their Morningstar ESG rating, but also their Morningstar rating. And then you can look at all other things like fees, the risk that the portfolio has, as well as performance metrics. So having said all that, is it actually worth investing ethically in terms of performance? Well, that ultimately depends on what you invest in, but perhaps one way of giving some insight into that is looking at another possible option for people who want to have somebody manage their money for them. They don't want to pick the underlying funds. So there's a range of robo-advisors out there that actually offer normal standard portfolios as well as ethical options. Now, I'm showing you on screen a full analysis we carry out on the best performing stocks and shares ISAs in the market. And if you scroll down, we have a table that looks at the performance of various portfolios from a range of robo-advisors, including Money Farm, Wealthify and Nutmeg. And we look at the 5-year annualized performance. We compare the equity exposure of each portfolio, so you can make sure you're comparing like with like. And we even break down the charges and the individual performance going back over the last 5 years. And in that way, you can see that often the ethical investments have performed as well, or in some cases outperformed their non-ethical counterparts. Now, that very much depends on the underlying trends within markets, because some ethical investments might have more exposure to technology, for example, and therefore when tech stocks do well, then some ethical investments will do so as well by osmosis. There is a link in the notes. You can look at the full details of that at your own leisure. So there you go, Andy, a roundup of ethical and sustainable investing and how you go about it.
Okay, so let's move on to the next piece of the podcast then. Now, I mentioned at the start of the show that Ofgem, the energy regulator, have been extremely busy over the last couple of weeks. The first was an announcement about the energy price cap, and that's going to be going down. I'll cover that at the end of this piece, because I'll actually cover also the latest fixed price energy deals and let people know whether it's a good time to fix or not. So let's park that one. Let's look at something else that was announced by Ofgem, and it was following a major review that they've conducted into the installation of prepayment meters, and it's resulted in a substantial compensation package for thousands of customers. The core of this issue is that a number of energy suppliers are found to have inappropriately installed prepayment meters or remotely switched smart meters to prepayment mode for a number of customers. Now, this often happened without valid consent, and in some cases involved customers in vulnerable situations. Now, what followed was a major investigation. In fact, over 150,000 cases were looked at between January 2022 and 2023, and Ofgem essentially found that the installations that were happening were either not safe or not reasonably practicable, and they determined that customers didn't receive the necessary support that they needed when they were getting into energy debt. So as a result, 8 major suppliers have agreed compensation. Now, those major suppliers are Octopus, and that also includes customers from Bulb and Shell, because Octopus took on those customers during the pandemic period, and also EDF, E.ON, Utility Warehouse, Scottish Power, Ecotricity, Good Energy and True Energy. Now, you may have noticed there's some major ones I've missed out there, notably British Gas, OVO and Utilita. Now, these are actually being investigated separately, so these aren't part of this initial compensation claim that I'm talking about. So as a result of those 8 suppliers being investigated, £18.6 million worth of compensation has been agreed, and those energy suppliers have agreed to this as well. Now, that is broken down as £5.6 million in direct payment to customers as compensation, and £13 million of that 18 million is being put into what they call debt write-offs, which will be fantastic news for those who are worried about that. So we've written an article on the Money to the Masses website which goes into far more detail than I'm going to cover on this podcast, and I'll put a link to that in the show notes. But ultimately, this compensation package impacts around 40,000 customers between that period, again, January 2022, January 2023. And I've got an article on screen now which just covers off how that compensation will be paid out to customers. Now, I won't read it all out. It is there for people who are watching it on the podcast, but it goes from £40 to £60 at the lower end. But those who were more significantly impacted by these breaches, if you like, can get up to £1,000 in compensation. And that is for an inappropriate installation, a switch, or use of the prepayment meters. And so if you listen to this and thinking, well, that could be you may be eligible to claim, there's no need for you to actively claim. The energy suppliers will be actively contacting eligible customers directly to arrange payments, and they will be credited to their accounts. For some, this will include having a portion of their debt written off as well. What I would say though is, if you do think it's you, then do keep an ear out, do keep an eye on your emails. And if you don't receive anything and you think you should have done, of course, you can chase your energy supplier. Ofgem has announced that it is expected to provide further information and updates in regards to this review, and specifically that will be regarding those other customers of British Gas, OVO and Utilitas. So do listen out, and we will put an update on the Money to the Masses website and probably do a quick update on the podcast when those details are announced. So as I said at the start of the piece, Ofgem have been busy. Let's also now focus on the energy price cap. The announcement has come out, and from the 1st of July, the price cap will be cut by around about 7%. So for a typical household with a dual fuel tariff, it means annual savings of around about £130 a year, or just under £11 per month.
So there will be a lot of people who listen to the podcast thinking, well, they hear the energy price cap goes up and then it goes down. I mean, where are we? Now, Andy has created a bit of analysis and a chart that shows the historic price cap movements. It's on screen if you're watching this show, and we put a link to it in the notes as well. And what you'll see is that the drop in the energy price cap from July really just takes the price cap back to where it was roughly at the start of the year, and it will still be about 10% higher than it was in July 2024. So that gives you a feel for where the energy price cap is going. And the predictions going into the end of the year are for it to fall slightly again. And of course, the further you go into the future, the less reliable these predictions are. But what is interesting is that the best fixed deals now are some of the best we've seen in the last 2 years when you compare them to the energy price cap. We put them on screen. Again, we'll put links in the notes. And the best fixed rate deals you can get in the market at the moment are about 20% below the current energy price cap. Of course, when that drops in July, it's still going to be probably about 10% cheaper than that. So it's still a good time to fix your energy bills. And the other thing that why we want to bring it to the podcast, there'll be plenty of people who may be fixed in the autumn last year or late summer that will be coming up to perhaps their deals coming to an end, and they want to look at what they could be doing in terms of fixing again. But more importantly, there were a lot of deals that people were on that didn't charge you exit penalties if you switch to another fixed tariff with the same provider. And so that means there are some really good deals out there that you could potentially, even if you've already fixed, move to an even cheaper fix now. So this is a job for everybody to do after this podcast. Look at what deal you're on and have a look at your energy bills, because you could potentially save money. Okay, so moving on to the last piece then, Andy, of the podcast. I know you were going to do it, but I'm so chipper. I think it's the buoyant mood of Spurs winning. My voice is holding out. I think I'm going to just go straight into it. And it's talking about that Cash ISA hack. And the hack really is that we've become frustrated with Cash ISA rates that are falling, particularly on easy access Cash ISAs. We've all been impacted. Now, if you look at the best rates out there on easy access, there are a lot of rates that have short-term bonuses attached. So we're talking about 3-month bonuses that then drop off, and the underlying rate on easy access might be 4.2% variable, for example. And the best easy access Cash ISA at the moment without any kind of bonus is 4.8%, and the next best after that is 4.63%. And the frustration is if you want to then move, it can take you quite some time to move your Cash ISA, because you have to stay within the wrapper and it requires form filling, and it can take a number of weeks for it even to be completed. But cash savings platforms exist that allow you to move your savings between different providers. And they work as a hub. You have one online registration. There are lots of different bank accounts within that you can have access to, and you can move your savings from one bank to another bank and its savings account at the click of a button via this hub. Now, the one drawback for a long time was that there were no Cash ISAs available within this kind of mechanism, and then Hargreaves Lansdown came up with a Cash ISA. Now, at the moment, they are the only people in the market that have this. This does feel like a bit of a promo for Hargreaves, but it's not. It's just they have a product that facilitates you to be able to move your Cash ISA to various different providers to try and secure the best rate as these rates keep dropping. So at the moment, if you're watching this, you can see on screen the best easy access Cash ISA rates at the moment with Hargreaves Lansdown is 4.4%. Now, as I've already mentioned, that is already near the best easy access rates that you can get at the moment. 4.8% is the best in the market, but then it's 4.63%. But a lot of the leading ones you're seeing headlines for, like Moneybox, for example, the underlying rate is only 4.2%, but they have a very short-term bonus rate. So the message for this part of the podcast is there is a solution out there. And Hargreaves Lansdown have a cash savings platform that has a cash ISA where you can move between lots of different banks if you want to try and secure a better rate. You're not necessarily going to get the best rate in the market, but as it stands, they have rates that are competitive within it. It's something to keep an eye on. They also have fixed rates on there, which are much closer to the leading rate in the market. The leading 1 year fixed rate in the market at the moment is 4.26%, and they give you access to 4.15% with Paragon. So it's a useful tool now that you can open up more than one cash ISA in a given tax year, that you might find this useful to use to maximize your interest. One thing to point out, when you are using the platform, when you move from one savings account to another with that cash ISA, you have to move into the hub and then on again. It's just a click of a button, but if you leave it on the platform, you don't actually earn any interest because you haven't moved into the other cash ISA. So just bear that in mind. But it's worth bringing it to the podcast because it is a savings tool that is separate to the main Hargreaves platform.
And just one other thing on that Hargreaves cash ISA is there is a bit of an annoyance with people transferring cash ISAs in. So if you look at that Hargreaves cash ISA and you think, do you know what, that's for you, I'm going to move over my existing cash ISAs from elsewhere, there's a bit of a nuance on it. You have to move it into a Hargreaves Lansdown stocks and shares ISA, which sits in cash, and then they move it from that cash pot in the stocks and shares ISA over to the cash ISA. So they admit themselves that there's a bit of a complex situation there. They're looking to iron it out. They said that they should have it fixed in the next few months. So just something to be aware of. So it's a bit of an annoyance, but the crucial factor is you can move existing cash ISAs from elsewhere into that Hargreaves cash ISA.
So that is it for this week on the podcast, Andy. As ever, please do leave a review from wherever you do consume your podcast. Also, don't forget to join our socials. It's not just images of me going to Bilbao. There's lots of content on there that never makes it to the podcast. And insights, it's on Threads, it's on Instagram, it's on YouTube, and of course in our Facebook group and TikTok. I do try and keep all the content different on those different platforms. And in Threads, I give a lesson and a Q&A question, so multiple choice question every day as well as talk about the contemporary news on Threads as well, which I don't tend to do on a lot of the other platforms. So do make sure you follow us on all of the different social channels and make sure you share the content as well, because it really helps us as a brand. And of course, don't forget to follow us on our YouTube channel as well. So Andy, I think all that's left for us to do is say until next time.
Until next time.